Welcome to Talk Tickers, where we break down the earnings calls that move the markets.
So today we're digging into Veru Inc, a company that gave investors some serious whiplash after its latest earnings call. I mean, look at this. The stock popped over 4% in the pre-market on what looked like great news, but then it completely cratered, closing down almost 9%. What in the world happened here? Let's get into it.
All right, first up, let's look at the numbers. This is the stuff that likely sent investors running for the exits and really explains that ugly close.
To start, Veru reported a GAAP earnings per share loss of $1.07. Now, to put that in perspective, Wall Street was only expecting a loss of around 50 cents. So yeah, that's more than double what was expected. A huge miss right out of the gate.
And get this, revenue from their old, now discontinued operations, well, it basically fell off a cliff. We're talking down over 73% from last year. This really hammers home that Veru is now a full-on, pre-revenue biotech company. They're all in on the clinical side now.
And here's the number that is absolutely crucial for any development stage company: cash burn. They burned through $30 million from their operations this year. That's a pretty big number when you've got no new revenue coming in the door.
Okay, so let's just put this all together. You've got a much wider loss than anyone anticipated, your old revenue streams are evaporating, and you're burning through cash pretty fast. You can see why investors immediately started asking that one big question. How long is their runway? How much time do they have before the money runs out?
But hold on, that's just the bad news, right? That's what caused the drop. Now let's flip over to the other half of the story, the narrative for management that got everyone so excited in the first place, their big pivot into the obesity market.
This quote from the CEO, Dr. Steiner, really gets to the heart of it. See, Veru isn't trying to go head-to-head with the giants in the obesity space. No way. They're trying to be the perfect partner, to come in and solve one of the biggest side effects of today's blockbuster drugs.
So what is that problem? Well, it's all about these GLP-1 drugs that you've probably heard of. They are incredible for weight loss, no doubt about it. But here's the catch. They don't just melt away fat. They take a huge chunk of your muscle with it. We're talking up to 50% of the weight you lose can be valuable lean muscle. And that is a major issue for long-term health.
In this chart, this is why the stock popped pre-market. It shows their solution in action. Look at this. In their trial, patients taking a placebo with the weight loss drug lost about a third of their lean mass. But the patients who got Veru's drug, enobosarm, they lost zero, zilch, nada. They kept 100% of their muscle, all while still getting significant fat loss. That is a potential game changer.
So, this isn't just a cool idea. Management made it really clear that they have a solid plan. They've got this great data in their back pocket, and they've already talked to the FDA, who basically confirmed their path forward. The next big thing to watch for is this new trial, the PLATEAU study.
So this brings us to our outlook. You see the disconnect, right? On one hand, you have a really concerning financial picture, and on the other, a clinical story that sounds incredibly compelling. So how do we square that circle? What's our take? Well, it really boils down to this classic bull versus bear fight. The bulls are looking at the massive multi-billion-dollar market and saying, hey, the data looks fantastic and the FDA has given them the roadmap. But the bears, they're laser-focused on the here and now. They see the cash burn, they worry about the company having to sell more stock to raise money, and they're pointing at the calendar and saying, the next big data readout is in Q1 2027. That feels like an eternity from now.
So where do we land? For us, right now, the scales tip just a bit toward the cautious side. The long-term potential is absolutely there. You can't deny that. But those immediate financial problems and that really long wait for the next catalyst, it's just too much to ignore. That's why we're giving it a market perform rating. At the end of the day, the market wants proof, not just promise.
Given that high-risk, high-reward profile, you might be asking yourself, how could you even approach this from a trading perspective? Let's talk about one potential idea.
This is really the million-dollar question, isn't it? How on earth do you trade a stock when its make-or-break moment is more than 2 years down the road? Again, that next big data drop isn't expected until the first quarter of 2027. Well, one way some traders might think about it is by using long-dated options. You could look at calls or puts that expire sometime after that data is supposed to be released in early 2027. The idea here is that you're not just betting on which way the stock will go, but you're positioning for a big move when that news finally hits. It's a way to get exposure to that huge potential swing without having to tie up a ton of capital in the stock itself for the next 2 years.
And of course, we always have to say it, this is for educational purposes only. This is not financial advice.